Hello and welcome back to RC Truth Media. Today I have a few things to show you. First comes from ValueWalk.com on an article titled "The Fed is About to Crash the Markets Again." Starts off saying Mark Twain is reputed to have said, "History doesn't repeat itself, but it does rhyme." If there's anything here that could be repeating itself, it's the inability of the tinkering Federal Reserve to get through a rate hike cycle without significantly impacting the market. I have a question for the audience. Now, does the federal funds rate, which is interest rates, have anything to do with the rising or dropping in the stock markets? Well, let's look at one sector in the stock market, which is the S&P 500. And I have a chart here to show you, which is the last 30 years. And the blue line is the S&P 500 over the past 30 years. The red line is the federal funds rate over the past 30 years. Now we can see the higher the interest rates, the lower the S&P 500, the lower the stock markets are. Okay, because the lower the interest rates are, that means, which is over here, which is low interest rates, that means you can borrow more money. When you borrow more money, your debt gets more, it increases more. So usually what happens with a rising stock market, you also have rising debt. Look at Venezuela. Look what happened to their stock market. It rose and rose and rose, and their currency also devalued and devalued because their debt, they went more and more in debt as well. And they also went into negative interest rates. Now Trump is saying that he doesn't want to do that. He sees the correlation here, and he wants to raise everything back up. As you raise interest rates, you raise the value of the currency also, and you also get rid of some debt. So that's what he's trying to do. Let's go ahead and let's see if there's anything we can read to you. Yeah, as we've seen from the recent past, the market might not respond immediately. However, the past two rate hike cycles saw the S&P 500 correct by 50%. Okay, so when the rate hikes went up, the S&P corrected itself. It went down. There's a growing concern among investors that newly appointed Fed Chair Jerome Powell and his merry band of central bankers, or banksters, for in the Fed types, will put an end to the stock market rally by increasing the federal funds rate. In the United States, the federal funds rate is the rate that banks lend to one another and can be looked at as the cost of money. While not an exact science, interest rates affect the economy by influencing consumer and business spending and thereby funneling down to changes in stock and bond prices. When interest rates are higher, business and consumers typically save more and spend less, which can be determined to economic growth. In that light, let's take a look at previous rate hike cycles to evaluate their impact. And this is what I showed you here. Alright, now let's go ahead and show you a different article here, which is from Zero Hedge, titled "The Corporate Yield Curve Has Just Inverted." Okay, and I'd shown another article about this a couple days ago, and this is a follow-up on that. Just days after we showed that the world's most systemically important banks are tumbling, even as U.S. stock trade just shy of all-time highs, prompting Ian Hartnett to issue his first black swan alert since 2009. Nedbank Analysis, Niels Heinck, and Mil Daya picked up on this topic, and in the latest note write that the market-weighted cap index of the FSB's GSIFIs starkly decoupling from the S&P 500 and the Nasdaq since the beginning of 2018 and nearly entering a bear market, or down 18%. They warn that this decoupling will be sustainable. Either the rest of the equities must come under pressure or the financial sector must rally. Okay, so two things has to happen. They're saying, reverting back to their favorite theme of dollar liquidity, or the lack thereof, as the catalyst for virtually all of the world's risk asset woes, Hayek and Daya show that whereas the S&P 500 has so far ignored the slide in the dollar liquidity, The mega banks have not been so lucky though, and that the higher dollar spike, the greater the threat to these banks, until eventually the drop is so substantial the rest of the market will have no choice but to follow lower. So that's what happens when you higher the interest rates as well. The liquidity drops and they can't borrow as much. It costs more to borrow money, and so you'll see um, the borrowing go down as well. And that's going to be in all sectors. The borrowing is going to go down. This will affect the economy, these rate hikes eventually. And coupling these rate hikes with what's going on in China right now, I don't see very good news headed for the stock markets and the dollar. We're in a trade war, and we're also, our relationships overseas aren't doing very good as well with our allies. And so we'll wait and see what happens. But I do see this as a time of change for everything. Okay, so go ahead and get you some cryptocurrencies, get you some Bitcoin. Right now it's a great price, about $6,300. Gold, always been a great store of value, same as silver, but silver is a little bit more bulky. You can also look at other precious metals that are good. And thanks a lot for coming to my channel. I'll leave a link so you could donate if you would like. Also leave a link for my Bitcoin wallet, and I will have a lot more truth videos coming out very soon. And you have a great day.